I want to get to Treasuries because the market's getting a sign that a recession could be on the horizon. It's what everybody's talking about. The yield curve inverting after the closing bell. Right now, you're looking at the 10-year at 2.4, the 5-year at 2.5, and the 30-year at 2.5. 2-year, by the way, at 2.39. But, man, we want to speak to you this morning about all this is Steve Leisman. Mr. Leisman, what say you?
Morning, Andrew. Yeah, so let's just do the background a little bit. After flirting with the zero line earlier this week and giving off a false negative, the spread between the 2-year and the 10-year bond officially inverted yesterday. That is, it went below zero, where the longer dated yield was below the shorter dated yield. Some saw it as a sign of imminent recession. Others thought it meant very little, either for the economic or the outlook for the Fed. The spread between the 2 and the 10-year, it turns negative sometimes before a recession. Actually, every time. Went as low as minus 0.3 of a basis point before it turned positive later. It now stands, what do we have now? 0.015 of a spread right now. So blink your eyes and it could be negative again. The inversion raises concern because it suggests the markets think the Fed will raise rates too high and too quickly, prompting a recession and then require an easing. That's why the longer end of the curve drops. The trouble is, recessions follow inversions anywhere from 6 months to 2 years later, so start your clocks now. Krishna Guha of Evercore ISI writing yesterday, we think the Fed will not ignore the 210 spread, but should not and will not be overly influenced by a mild inversion on this particular metric alone. He still expects the Fed to hike 50 basis points in the next 2 or 3 meetings and start reducing the balance sheet as well. The Fed, for its part, focuses on a different spread, the spread between the 3-month and the 2-year bond. It's massively positive at the moment, almost like the U.S. were in the middle of an expansion. What it reflects is an expectation of Fed rate hikes for at least the next 18 months. Now, this spread inverts 5 months closer to a recession than the 210, or an average of 11 months. We'll get a read this morning at 8:30 if there's any sign of slowing in the job market. But right now, the expectation, strong job growth is expected to continue, Andrew.
So the second metric which you suggested, which I guess, I don't know if it's a lagging indicator, but it's not as early as an indicator. Is there any time in history, by the way, where there's been the inversion and then we haven't had a recession? I mean, how many examples are there of the recession? How many examples without?
So the 210 is well, it depends on how far you want to go back. I've got in front of me from 1980. It's 5 for 5. Hold on, I'm going to count it. And the 3-month, 2-year gave off a false signal. 1, 2, 3, 4, 5. It's actually 6 for 6 on the 210. It turns, by the way, it tends to turn negative for a little bit longer than we had yesterday. Yesterday, I believe it was 442 in 10 seconds, and it was there for like 5 minutes or something like that. The 210 is really 5 for 5. I guess it gave off one false signal, maybe in the middle of the 90s there. The 3-month, 2-year, again, you're right. It ends up being closer to the recession, but there was one false positive in there.
Shepard Smith here. Thanks for watching CNBC on YouTube.